We'll always have these traders to run over. The institutional traders do it, and as commercial traders, we need to do it too. Now, the other one is Fibonacci. Now, Fibonacci was a 17th century mathematician who looked at Fibonacci transformations. And I looked at them really, really hard. I have a whole bookshelf of stuff on Fibonacci. Fibonacci transformations are really elegant numbers, but when he created them or discovered them, the financial markets were not even around. Now, as much of a lousy indicator, and I'll show you, is Elliott wave. At least Elliott tried to make it compatible with market movement. Fibonacci didn't even try to do that, but somebody had the bright idea of moving it over into a financial instrument to try to determine future price. Now, here's the thing. Sometimes you see Fibonacci levels hold, and sometimes they break. And when they hold, everybody crows and says, you know, how great is Fibs? But the problem is you have to look at their precision. I mean, do they have predictive power in helping you get into a trade that's going to increase the predictive value of your entry? And they don't. And what we did was we looked at 2 years of market replay data, trading off a fib as support, or trading off a fib as or trading off an upside fib as resistance, and they simply don't work. And I have never seen a trader that trades fibs trade profitably. Now, maybe you include other indicators that help your trading precision and bring you back, but if you just trade fibs, you're going to get really beaten up. So the predictive value of an indicator that assimilates data, and here's the overall take home. If the indicator assimilates data from your trading chart, then it doesn't have any predictive value. And people are always talking about how indicators are lagging indicators. And they're absolutely correct. If they trade off of price on your financial instrument, no matter what the indicator is, they don't have any predictive power at all. And what you see are most day traders loading up on all sorts of indicators, and they all assimilate data from the trading chart and have no ability to look out into the future. And that's why 95% of day traders fail. It's a mindset, trading a methodology that just doesn't work. Now, you have to have, first of all, if you base it on math, you have to have an overall idea of the math. Now, if you trade with sensitivity, now I hope everybody heard everything else I was saying, because I just got a note from. Let me see here. Hold on a second. Okay, okay. I'm going to start over. Let me see if there's, because I just heard the GoToWebinar, so we got it. Do you hear now? Okay, great. Thank you. All right, I'm going to start over again. I'm sorry. I don't know why it didn't. Okay. All right, we're starting from the start, and because I just heard GoToWebinar say the webinar is now starting, so I apologize for that. Because I saw a lot of people coming and going, and that was the reason. So let me just reintroduce myself. My name is Mark, and I'm with Right Line Trading. Just my background, I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia, and I've been involved in the financial markets for over 20 years. And I began trading the futures and forex markets about 10 years ago. And my background is in mathematical modeling. And what I did in graduate school was to create mathematical models for underwater decompression schedules, so that deep dive. Now, I went to graduate school a long time ago, and doing underwater decompression was very, very difficult and very dangerous. And Navy divers would go down many hundreds of feet. It was very, very difficult for them to come up from that deep dive, and it would take hours and hours for them to do it. They used to have to change gas mixtures on the way up. They used to have to take pit stops and wait for 15 or 20 minutes. And nobody had any idea what the optimal underwater decompression schedule was to optimize these variables such that the dive time was minimal and the probability or possibility of getting underwater decompression sickness was minimal. So it was a play between two things. You want to get the diver up as fast as possible, but the faster you move up, the more commonly the diver will get underwater decompression sickness. So that's what I did. The program was Automated Engineering and Scientific Optimization Program. It was written by the U.S. Navy, and when I started looking at the financial markets, I looked at them as any other closed system, just like underwater decompression. Future price is defined by a series of independent variables. You just have to determine what they are. If you put them in a multivariable equation and optimize that equation, you'll describe the movement of future price. The key is you have to determine what those independent variables are, and then you have to optimize each independent variable. It's very, very important not to put in a dependent variable, because if you do, it simply confounds your trading and it doesn't give you the kind of precision that you need. Now, a lot of the trading indicators and software systems that you look at right now are throwing dependent variables into your face. That indicator is dependent on the movement of other indicators or the movement of price, and you'll see what I'm talking about. Those are the things that you don't want to trade. Now, one thing I mentioned is our last 5 trades that we took in the live trading room were winners. 5 out of 5. We made really nice money this week in a very, very low volume environment and a difficult area to trade, simply taking into account all the independent variables and optimizing our trading entries and getting winners. Now, the problem with current technical analysis is that it doesn't work, and that's why 95% of day traders fail. Now, it just locks at 95% as each generation of day trader doesn't make any major changes in their trading methodology, and they don't learn. There's no evolution in this field, and it just everybody keeps accepting a priori the indicators and analysis that have been present, since the 1980s, and that walked people, down that path a long, long time ago, and nothing has changed. Software developers just throw out the same stuff. They don't look at the precision of the trading entry developed by the indicator. I'm going to show you exactly what I'm talking about. So the bottom line is you can't accept as anything as being true unless it's proven to you mathematically. I mean, that's a scientific ethic. If somebody tells you an oscillator works, you have to make them prove it. Somebody tells you that this works, you have to show it to them. You have to make them show it. If somebody tells you that a software-generated trading entry works, they have to show you why, and they have to show you the math. If they don't, they haven't showed you anything of any importance. And if I do a Nexus Lexis search of the world literature, there's almost no clear-cut scientific analysis published that looks at the value of any a trading indicator, a trading signal, or a trading methodology. So we're really out in the boondocks because we don't have anything to help us. There's no scientific work is being done in this industry to tell us what works and what doesn't work. So you have to be very, very, very careful as to how you move forward. Now, I see this all the time, and this is just the example that I want to show you, and that's the combination of an oscillator and Renko bars. And there's a lot of software that combines them. And the reason they're combined is because the developer has no idea what the parameters there are in the formula for the oscillator. Now, it doesn't matter what the oscillator is. It could be relative strength, it could be stochastic, it could be Williams K, it could be the ADR, ADX. They're all momentum indicators. There are people that say that an oscillator is not momentum. That's absolutely untrue. It is a momentum indicator. because as the close of the candle approaches the high of the candle on a long trade, it shows you that momentum is strengthening to the upside. And as the close of the candle approaches the low of the candle on a short trade, it shows that momentum is being enhanced to the downside. So it compares 4 parameters: the high of the candle, the low of the candle, the open of the candle, and the close. Now, each oscillator puts those 4 parameters into a slightly different formula to create its percent K. And in order for that percent K to work, you need those 4 parameters. So here's a nice percent K. Now, this does not get into whether or not the percent K helps you trade. We're just looking at whether or not it's an appropriate percent K. And that's an appropriate percent K. But if you look at Renko bars, there's a high and a low, but there's no open or close. There isn't enough data on the chart to get you an appropriate percent K. So all the percent K is just tracing out price. So if you trade a stochastic crossing of the percent K with the signal line, it's not telling you anything about future price movement. And in fact, waiting for these signals are just gonna trip you up, because what they've put into the software is a dependent variable. The movement of stochastic, in this case, is totally broken, but I don't want to get ahead of myself. Now, day traders, and I'm going to show you great, really awesome swing trading setups. I mean, they're so good that I'm thinking of looking at an algorithmic entry on them, because they're really terrific. And the thing that you have to eliminate is something like an oscillator setup. Now, if you look at all the traders who trade an oscillator, and you look at what they do when the market is overbought, half those traders continue to buy every time a long pivot is broken. And then when the trade finally peters out, it won't break an additional upside pivot. So they're looking to say, when the market's overbought and continues to make higher highs and continues to break upside pivots, I'm going to buy it long if the market's overbought. It shows us that the bulls are firmly in control of this market, and I want to go long. The problem is that the other half of the traders are looking to trade divergence. They're looking to trade price making a higher high and stochastic making a lower high, and they're looking to fade it. So you've got half of the traders looking to continue to buy long, and the other half looking to fade. And if you trade divergence, how inaccurate it is, how it has really no kind of authentic precision in helping you enhance your trades. And if you continue to buy these upside pivots, they're also going to stop you out a lot, because you can't guarantee follow through on the trade. So both of these entry systems just don't work. And what I want to show you is that on this long move, this is an institutionally created move, and I keep saying I'm going to show you, but I am going to show you how we look for institutional trades. See all these traders in these red candles? Well, they're fading the market. Now they're fading it on a different time frame, looking at a different chart, but they're trying to counter trend trade a long institutionally driven move. And you can see that stepping in front of this long move is a catastrophe. Every time they go short here, they're run over. They go short here, you get 2 red candles, they're run over. Go into consolidation. Consolidation almost always breaks in the direction of the trend. Up it goes, they're run over. You get a pullback, a continuation long, they're run over. Everybody continually gets run over. Now eventually, on the 4th, 5th, 6th, or 7th try, the market is eventually going to roll over. The issue is this: you can't predetermine when that roll is going to take place. All you can do is, if you have a trading entry, go long, and if you can't, do not counter trend trade. Now, the other indicator that a lot of traders use, both on day and swing, is the Fibonacci. And Fibonacci was really a rather obscure 17th century mathematician. He created Fibonacci transformations, and they're really neat-looking formulas that create Fibonacci numbers. But when he created these transformations, the financial markets weren't even invented yet. Unlike Elliott wave, which doesn't work, at least Elliott tried to describe price movement with those 5 waves. But Fibonacci wasn't trying to describe price movement in a financial market. So somebody had the bright idea 25 or 30 years ago. We don't know who it is, so we can't beat him up. But he decided that he was going to throw fibs into the financial markets and tell everyone that they have future predictive power is in terms of where price is going to go. And the fact is they don't. And what we did was we put 2 years of market replay data and ran it and looked at what was the predictive power of trading off Fibonacci support long or taking a short trade off of Fibonacci resistance short. And it doesn't have any predictive power. So if I know a lot of traders that love Fibonacci, you know, it's kind of elegant and it has like a sexiness to it, but it just doesn't work. And I've never seen a Fibonacci trader show me that they can make money. The other one is Elliott wave. I'm not going to talk about it here, but Elliott wave does not work. So the predictive value, and here's the take-home point from this. The predictive value of any indicator that assimilates data from your trading chart only is really horrific. And if it doesn't have a significant if it doesn't provide you with data that increases the precision of your trading entries, it must be eliminated. What indicators are that give you signals of price on your trading chart are dependent variables. They move based on other things. And if you use a dependent variable and not an independent variable to take your trading entry, it's simply going to prevent you from getting into winners, and it's going to stick you in losers. You can't trade dependent variables, and this is why 90% of day traders fail. They don't look at trading as a science, and there's too many people out there proffering software that's not scientific. And the reason is they don't really care. Now, you have to have a trading methodology that's based on math. You can't just take it. I mean, if somebody provides you with a piece of software and they can't tell you what the sensitivity, specificity, and predictive value of the trading entry is, then you shouldn't buy it. Because if they can't tell you these numbers, then they don't know anything about how successful it is. And they can throw you all kinds of numbers at you. But these are the numbers that, you know, that cut right to the bone of the software. If I take an entry based on the setups that the software trades, what's the likelihood that that signal is going to get me a winner? I mean, if you don't know that, then you don't know anything. Now, here's the other important thing. In your head, you can trade with one of 2 methodologies. You can trade with sensitivity or specificity, and you have to take a side. You can't say, I'm not going to do either, and you can't also say, I don't know what either of them mean. Because if you don't know what they mean, and you don't pick a side, then you cannot day trade profitably or swing trade profitably. And if you trade with sensitivity, you're looking to get into all the winners. That's a true positive, TP. If you trade with specificity, you're looking to avoid all the losers. And you will avoid losers at the price of sometimes staying out of winners. And I'm telling you, the best way to trade is to trade with specificity. You have to wait till all your independent variables align and take a trade with specificity. Because if you try to get in on every winner, you're going to pull in a lot of false positives and you're going to get losers. And day trading successfully, or swing trading successfully, is all about avoiding losers. It's much more important to avoid a loser than get a winner. And that's what your mindset has to be. It's going to be, you know what, I didn't get into that 20-tick move on crude oil. I didn't get to that 5-point move on the E-mini because it didn't set up. it didn't show as being a true positive because it didn't align with your independent variables. But that's going to save you a lot of losers. So we get a lot of losers today on our trading charts. We had 5 of them, but because we traded with a tremendous degree of specificity, we only got the winners. And ultimately, the positive predictive value of any trading signal, whether it's based on market structure, price action, or indicator analysis, is sensitivity over specificity times prevalence. Now, prevalence is how often a winning trade occurs. And the key to trading with prevalence, which is a very, very important independent variable, is trading only when your software defines a trend. Your trading entry is more likely to get you your first target and lock in profit when you trade in a trending market. If you trade in a chop market and you multiply really good, I mean, your bias is I only want to take, when all the independent variables align, I'm only going to take a short trade or a long trade. So you're trading with specificity, but you're not trading a trend. If you do, it's going to really hurt the precision of your trading entries. That has to be the way you want to trade. You want to stand down on some of the winners to avoid the losers, and you want to only trade in a trending market because that's when the likelihood of getting a winner is most likely. So the prevalence of a winning trade increases in a trending market. And this is a little esoteric, but I always used to wonder why the heck markets chop. I mean, who makes money and who loses money? And I don't have any idea, but the financial markets, if anything doesn't convince you that these are governed by the same laws that govern any closed system, just look, the law of thermodynamics states that any closed system has this tremendous desire to go to maximum chaos. Now, unless you apply energy in physical systems, or you apply money to the financial markets, the markets will chop. And when the markets chop, you cannot trade because the prevalence of a winning trade is very low. So you have to look at the financial markets as simply a closed system that are desperately looking to move in a chaotic fashion. That's their inherent property. And the only thing that's going to create a multi-time frame alignment of price is when the institutional players come in and they apply the financial market instrument of energy, and that's money. That's the only time we want to trade. And we want to trade in the direction of that money. So what are our independent variables? We're looking for a multi-time frame analysis of trend, a multi-time frame analysis of order flow, momentum, and we're looking at the multi-time frame analysis of market profile, and also the directional correlative markets, and I'll show you that. The dependent variables that don't work because they're driven by these independent variables are the oscillator, Fibonacci, Elliott wave, and I put MACD up here, but MACD is actually a very nice momentum indicator that we use, but you'll see we don't let it assimilate data from our trading chart, and that helps it. The oscillator, no matter what you look at, will never help you trade. And it's either with Fibonacci or Elliott wave. So let's just take a quick look at what all the indicators tell you. Now, this is our 3-line indicator, and we got rid of one of the lines because that line was at the oscillator. So all we look at, the upper line is the multi-time frame analysis of momentum, and the lower line is the multi-time frame analysis of order flow. Now, when the line is red or orange, that's telling you that the top line is telling you that momentum. I'm sorry, the top line the top line is momentum. I'm sorry, that momentum is aligned to the downside, and it doesn't analyze momentum from your trading chart. Remember, I said that using data on your trading chart is only going to confound you. Price on your trading chart is going to move in the direction of your 2 higher time frames almost every time. That's got to be your directional bias. And this indicator is only providing you with a directional bias. So when you have your 2 higher time frames aligning to the downside, you've got red, red, momentum, and order flow. You're going to take a short trade. The same thing with orange. Orange means your much higher time frame is to the downside. You don't have a total alignment with your second highest time frame, but the highest time frame rules and your short bias is always in the direction of red or orange. Now, when you get blue and green, this is on order flow, which means there's an excess of traders on the buy side as opposed to the sell side on your two higher time frames. And what this is the moving average of the market delta that's created on each individual candle placed into a moving average and smoothed. Because market delta is horrific to trade. But if you get a smooth moving average based on your two higher time frames, it really does portray a nice analysis of whether there's an excess of buyers or an excess of sellers. Now, when momentum and order flow don't align, you can't trade because you have opposing forces on this candle, and the precision of your trading entry is going to drop. If you trade when both lines are red, the precision of your trading entry is going to go up. And here is an example. And I didn't cherry pick these examples. I can give you a million of them. Here is order flow and momentum. And you can see what happens when it's aligned to the upside. Now, what this makes this indicator so appropriate to doing a look back is that the color of the indicator has nothing to do with price on your trading chart. It doesn't care what direction price on your trading chart is moving. It's looking at the movement of price on your higher two time frames. Momentum is looking at higher price, and order flow is looking at the market delta on your two higher time frames. And you can see how powerful its assessment of trend is and how it helps you create a trading bias. For this whole move up, you're only looking for retracement and a long trade. When both of these colors align to the downside, you're looking for an appropriate short trade. You're not looking to go long, or you're going to get run over, or the likelihood of you getting run over is much higher. Same thing with the short trade here. When they align to the down, and here's what's really nice about using this indicator. When the market's choppy, they just don't align. You're going to find order flow red, momentum green. Then momentum will go green and the order flow will go red. They just don't correspond. And that's a warning to you. Stay away from the market. When they go red, analyzing price movement on the two higher time frames only, you've got a strong down bias. You just got to get yourself an entry. We're not talking about entries yet. We're talking about trading bias. When the 50 is red heading down, when the 15 is red and heading down, and you've got red, you're looking for a retracement and entry. That's what you're looking to go. You're never going to go long. And you see these B candles, all these green candles, they're all traders trading in the counter trend direction against momentum and against order flow, and all they do is get beaten up constantly. And they continue to do it over and over again. We don't want to be these traders. We don't take counter trend candles and surmise based on an oscillator or some other indicator that we've traded to a bottom here. The bottom is going to form when the institutional traders decide it's going to be there. It's not going to be based on an oscillator. And this tells us when the institutional traders are with us and when they're not with us anymore. Order flow will not align to the downside on our two higher time frames unless the institutional traders are really pouring short contracts here. And it could be short shares, it could be short on the Forex, where you trade lots, doesn't matter. Now here's the multi-time frame analysis of trend. You get this pink background bias when the two higher time frames are moving to the downside and all support to the downside is broken. It doesn't look at price on your trading chart. So when you get your two higher time frames and the indicator will assess, you can trade a range, a time, a tick, a Renko, and it will determine what your two higher time frames are without you putting any information into it. And it's going to crank out this color. And when you get a multi-time frame alignment to the downside, that is almost never going to occur in random. It's almost as a random chance event. It's only going to occur when institutional traders bring money to bear to create order in this market. And what you're looking at is a multi-time frame alignment to the downside. it's always going to pull the price on your trading chart to the short side. And you see all these traders going long, all these green candles. They provide us with trading opportunities to continue to trade short in the direction of the big money. And here's another. You need depending upon your ATM, you could have gotten 14 points here, and you could have gotten 11 points here. You need to take a substantial amount of risk. But when the point of showing you this slide is that when both time frames lock green to the upside, it's going to pull price up on your trading chart. And you're going to see that over and over again. So I'm going to show you the full platform. So again, along with order flow and momentum, it creates a strong directional bias, and we don't trade against it. And all these traders on this long E-mini move that create these red candles are all getting pounded because they're going to get run over until the institutional traders step aside and they say, I'm not taking the E-mini higher anymore. And there is no indicator that's going to predict that. Now, these are correlative markets, and this is a very strong additional independent variable. Now, this is a chart of the E-mini. So the E-mini makes a strong down move. Well, what market is likely to fall with the E-mini 70% of the time or greater? And it's the NASDAQ. So that's a correlative market that correlates in the same direction as the E-mini. And which markets are likely to go up in a counter-trend direction 70% of the time or greater? And that's Treasury bonds and Treasury notes. Now, if you try to analyze price, it's very difficult. What you need to look at are smooth moving averages. And you need to look at them on multiple time frames of these correlative markets. And there are lots of correlative markets on the E-mini. There are all the mid-cap stocks, and there are basically, when the E-mini falls, that means risk is off. And institutional traders are pulling money out of the E-mini. It's sinking along with the NASDAQ, along with the Russell, along with other markets, and they're moving it into safer havens like Treasury bonds and Treasury notes. What we want to do is be able to track this type of sector rotation. Look at the flow of institutional money, wait for them to align, and what is unlikely to be a random chance event, because it rarely occurs that all these correlative markets correlate all of a sudden to give us a long trade. Now, this is Treasury notes, Treasury bonds, and there are three markets in each line. And when they lock green to the upside, and again, they do not look at price on your trading chart. They don't care whether price is going up or going down. We look at other time frames for certain analysis, and we look at other markets for other analysis. So we know that when we get dual greens, the institutional traders are pushing money into bonds. And this is, again, it is just a trading bias. No entry here. We just know when we got dual greens, we're looking for a long trade. And just having that information alone will allow us to avoid a huge number of losers. And here's what it also shows. When these lines are yellow, it means that the institutional traders are standing down. They're not doing the rotation of money. And what happens to the market? It simply breaks down into chop, just like that any other closed system. Without the financial markets around to govern price, the markets just chop. So it increases the probability of your trading entries long, and it defines areas that you don't want to trade, even if you get a great entry based on price action. And price action is really important, and you'll see how we leverage it. But we want these dual greens, and you'll see we'll put it all together. But each of these are important independent variables. If you trade with specificity, you want every independent variable aligned. You want to leverage them. You want to use them to increase your trading entries. Now, again, and I want to repeat myself, this is going to pull you out of some winners, but it's going to allow you to avoid a lot of losers. And that's the difference between being profitable and unprofitable. Almost all day traders get nice winners. What the unprofitable ones do is they pull in too many losers. And here's what happens when we get a lock. Now remember, this is the same slide I showed you for background bias. When the higher time frames go green, and you'll almost never see green, the higher time frames locked to the upside based on the moving averages of those price, and that's market structure, unless all these there are 9 correlative markets on the E-mini, unless you get green, green, green. That's where institutional money is coming in and blowing the E-mini up, right here and right here. We don't see this alignment that often. You're going to see it multiple times on a day trading chart, but you just have to wait for it to appear to increase the probability of taking an effective long trade. And the other that we look at is that's very important. We have a very, very powerful market profile indicator. Now, in a perfect world, which we don't have, 1 standard deviation's worth of volume describes fair value. And fair value is the price that traders have decided they want price to be. They don't want price to pull out of fair value, which is above that 1 standard deviation. That starts putting price out into these wings. And traders don't want it to go there. Now, in a perfect world, this is a normally distributed volume. Now, we never see that in real life, but that's the mathematical basis of creating market profile. And that is at the point of control, or the mean price, is the price that is most often traded, where traders want this trading instrument to be most often, sits right in the middle of this volume distribution. And that's the mean price, or the point of control. And we know, again, this is not the way it works. But this is the principle that guides it and tells us that we're trading this indicator is based on sound math. We know what the underlying formula is, and we know if we don't respect it, it's going to hurt us. Now, it's going to keep us out of some winners, but it's going to let us sidestep a lot of losers. Now, here's our indicator. Now, on the indicator that I use, I eliminate this histogram. This is the volume profile, and it's used to create market profile. And once I get market profile, I don't trade these. I don't trade this histogram. Now, here's the key that's extremely important. In the analysis of price, remember that 1 standard deviation's worth of volume, or 66 2/3% of all volume at price, is bounded by the value area high and the value area low. And price wants to desperately stay within these bounds. So as price heads down to the value area low and up to the value area high, price is going to be repelled off of it. So this is a strong area of resistance to the upside and support to the downside, as long as price is within this area. And one of the mistakes I see a lot of other indicators are creating is they'll put that one is an area of support and one is an area of resistance, and that's simply wrong. They are areas of support and resistance as defined by where you have to look at where price is. I'm going to take that up again. Now, what we also looked at is our market profile indicator. There's a lot of low volume nodes. Now, they're the opposite of the point of control. The point of control is the histogram bar that has the most volume. And this point of control is a price attractor. It wants price. POC strongly attracts price, and it does. It wants price, the price of a financial instrument, to trade at the POC. That's where traders in this auction style trade, people are buying and selling. It's just the gavel's falling all the time. This is where they want that price to be most often, at 53.49 on crude. So the point of control attracts price, and then it sticks because it wants to stay there. The value area high and the value area low repel price. So price is forced into the center of your market profile. Those are the forces that come to bear on your trading instrument, and it's very powerful. Now, if you try to trade through an area of support and resistance as defined by volume profile, you're going to have a lot of problems. Now, these low volume nodes, we determine, and you can see there's very low volume in the histogram, but there are lots of low volume nodes. These are critical low volume nodes because they're low volume nodes near the value area high and low volume areas near the value area low. So they're going to repel price because price doesn't want to trade near a low volume node. That's a price that traders don't want your financial instrument to trade at. So it's pushed off, and it's pushed off the value area low or off the value area high by a totally separate force. That separate force is the desire of traders to keep price within 66 2/3% of overall volume traded in that given session, or what your look-back period is here for volume profile. Now here's the thing. If the volume profile analysis is only based on 1 day of data, you already know what happens with that. 1 day of data is not enough. Now you can't do a look forward on this because volume hasn't occurred yet. So what you have to do is you have to do a multi-time frame look back, and this indicator has to store volume data. You can't do it on NinjaTrader, and that's right now we're close to Sierra, but that's the only platform that we work on. And this indicator takes up more of your desktop resources than any other because it's a storage indicator. And what it creates are these. These are zones of rejection. And these are areas where price does not want to move through. Again, they're repelling price by two forces. Price wants to stay in fair value, and it does not want to trade through a low volume node. And when they're together, and this rejection zone is tight, it's small, it's a very powerful area of resistance to the upside, support to the downside, but you can't categorize it as resistance or support. That depends on where price is on your trading chart. But it does a multi-time frame look back, stores the data, and creates these really powerful areas of support and resistance. If you don't respect them, or they're not present when you trade, you're going to take trades that don't work, and you're going to wonder why there's no follow-through in a given entry on a financial instrument. And it's going to be because it hits this rejection zone and bounces. And here's what we look for it to do. Eventually, price breaks all support or resistance. We just can't determine when price is going to go through and when price is going to bounce. Now, unlike a pivot that weakens every time it's hit, these areas don't ever weaken. What happens is they're going to move when volume profile changes, when those histogram bars are different. And this indicator corrects these zones intra-candle, which is incredibly important, because every time a single contract or a single share of stock or a single lot on the Forex is traded, this volume profile changes. Every time 100 is traded, it changes. If you can't get an up-to-date analysis, then you're going to take losers. If you trade a 3-minute chart and you get an up-to-date analysis every 3 minutes, you're going to get hurt. Because at the end of that 3-minute candle in the close, you're going to find that a zone jumps right in front of your trade and it's going to stop you out. So you get an up-to-date intra-candle analysis to keep you out of taking trades that have a lower precision, a lower probability of being successful. And I'll show you what happens here in this trade. What you get, just hold on 1 second here, is that you get break of support here, and then a pullback into what's now become resistance, and a trade to the downside. So it's giving you areas to avoid and areas to trade off of, which is very, very helpful. You can see up here, you're trading into resistance, you don't trade. And then price comes down. I mean, we would look at background bias, we would look at momentum, order flow, but you can see it doesn't make any difference what they show. We're not trading into support or resistance. And then finally, I'm going to show you the actual system-generated entries. The first one's a strategy entry. The strategy entry on our charts is an X. but actually made this X so big it became a square. And what this is, it's a smart indicator because it analyzes data from multiple time frames. And the entry is based upon market structure. If market structure provides you with an optimal trading entry, you're going to take it. Now you have to do a little bit of work. You have to make sure the 50 is red, the 15 is red, and then the strategy fires and down you go. It's looking at market structure and price action based off of data on your trading chart. You just have to make sure that the multi-time frame, actually it does a multi-time frame analysis, I'm sorry. If you open up the indicator and look, you have to put the higher time frame number in it. And here's 2 more strategy entries. They're very good. You just have to make sure that your analysis and your entry align with all the other indicators. But it's like I said, it's a smart indicator. We don't do anything that assimilates data or price action from just your trading chart. If you do that, you're going to take lots and lots of losers. You're going to get lots of false signals. And here's our ABC entry. And this is the A, here's the B, and here's the C. And God forbid, the truth is that ABC pattern is really a slice of Elliott wave. It's the only thing he got right, but we don't base it on the 1, 2, and 3 wave. What we look for is the A is going to print on your trading chart when you get 2 candles of the same color. You're going to get an A. 2 candles of the same color to price action traders defines a trend. So as soon as you get 2 reds, you got an A. Then you're looking for a counter trend candle. Now I elect to create that, to make that counter trend candle magenta. And you're going to get an audible beep when the B is forming. I'm sorry, when the B prints. When the B prints, you have the potential for a trend trade with an engulfing C. And the power of this engulfing C is this. It's going to overrun all the long traders in this counter trend candle. So it's going to get pulled down by 2 forces. We know the institutional traders are going short because we're going to define a multi-time frame move short. So we're going to trade in the direction of institutional money, and they are very likely to start running these traders over in this counter trend candle. They're going to pour more short contracts here, so the trade is propelled down by 2 forces: the addition of additional short contracts in the market, short people selling, or short contracts in lots or short lots. And that B candle is going to get run over. And when these traders get run over, they're going to push this market down. As the B candle, as the traders long in B get stopped out, the trader is going to get pushed short. They have to sell their contracts in order to unload their long positions. Here's another C. Now again, the C is going to give you every ABC pattern that prints. You have to make sure the 50's down and the 15's down, and you're in, and down it goes. You can see the principle though. When you see all these traders in these counter trend candles, they all get run over, and they're trading oscillators and using an analysis that's based on all the old theory and old dogma. Maybe they're trading fib numbers or Elliott wave, and they're all getting run over. Now here's another move. 36 ticks on crude to the downside, 36 upside. Now you're not going to get a 50 red and a 15 red and a counter trend candle and a C engulfing unless you, most often you're going to have institutional traders pushing this market short. But we have other indicators to confirm that. But you can see how powerful it is when the 50 and 15 is down. When the 50 and the 15 is long, you can see how powerful a C candle is to the upside. A really, really powerful trading entry. It's software generated with an audible alert on the B. And here's our consolidation entry. This is very helpful. I love the signal. And what happens is the software is pre-formatted to create a consolidation channel. And when you should take a trade, you get a green triangle intra-candle, not at the end of the candle, because you want to be in the candle before the candle closes to the upside. So you're going to intra-candle here. When you see that green triangle occur, the candle matures to the upside and gives you an entry. You're going to be long. You're going to take a buy stop on the close of the candle to the upside, and you're going to be long as soon as the candle closes. Now these were two green triangles to the upside. If you took the first one, the trade gave you some heat, but it never stopped you out, and you took a nice long trade on the E-mini. Now, I just want to tell you quickly what happens in consolidation. In consolidation, you have traders trading a counter-trend candle. Now, they are almost always going to get beaten up, but they've got some power here, these counter-trend traders. They form a down candle, then there's a trend trade to the upside on a green candle. Then the counter-trend traders come in to create another red candle. We want them to create this channel as long as it can get, right into support. Support's going to break this consolidation signal, and it's going to read that we've hit support and give you a long trade. You're almost always going to get a break in consolidation in the direction of the trend because it's created by the flow of institutional money. And that's the direction we want to trade in because that's the way we're going to make money. Here's another trade. It's a little risky because the 15 is below the 50 on our trading chart, but it just shows you the power of this is a software-generated entry. And what you have to do is make an assessment, intra-candle, of all your independent variables and decide whether you're going to get to this trade long or short. You have to listen, if anyone tells you you don't have to do a little work, they're crazy and they're misleading you. You do, but you need the software to carry its weight. And this is a great signal long. And these are short trades out of consolidation and long trades. I'm going to show them to you on our chart. Now, optimally, we want to get a long trade where we've got the correlative markets and we've got background bias. We're going to leverage all our independent variables to give us the optimum trading entry. And depending on your risk, you're going to wait for all those independent variables to align. You're going to take a very safe trade long or a very safe trade short. Here's a long trade on the E-mini. A break and pull back to the point of control and a continuation to the upside. This is 3.75 points. This is a trade I took. It was a way back. It was in September of 2016. But it's a long trade and a beautiful trade. All the correlative markets are here. Background biases. This is cyan. This is a strong long signal. Not as strong as green, but there are three long colors. Now, when you don't have any background color, there's no a multi-time frame alignment. You can trade, but the software clearly tells you when your risk is maximal and when your risk is minimal, and that's all software can do. It has to define risk. And here's another trade to the short side. Background bias is pink. Multi-time frame analysis to the downside. It is defined risk for you. You know that if you take this retracement candle short, you're very likely to get a winner. That's all you can ask the software to do for you. Here's a long trade. And I'll tell you, when you get this kind of background bias, you're not trading up into resistance. You get all three quant lines aligned. Your likelihood of getting a loser is extremely low. This is telling you that money is flowing into the E-mini. Your higher time frames. So here's other markets than the E-mini. Here's other time frames than the E-mini, this background bias. What's looking at price on your trading chart? Nothing. We don't care what price is doing on your trading chart. This bias based on the correlative markets and background color have to be based on information that's assessed outside of your trading chart or becomes a dependent variable. Independent variables don't look at price on your trading chart. Now, this is a transition zone entry. We haven't seen many lately because the market's been so choppy. But here's a 34-tick trade. And the transition zone is only going to take a short trade when you've got the correlative, there's three correlative markets on crude. When the correlative markets are telling you that money flow is coming out of crude, and you're looking for retracement into resistance and a continuation short. What we always do is look to leverage traders trading a counter-trend candle. If you do that, you're almost always going to beat them up. Here's another transition zone. This one's 34 ticks. It's a trading entry, and it's one that we got, but you can see it was in October of this year, so it was a ways back. But that's an entry running over the traders in the counter trend channel, or the counter trend candle right here, trading in the direction of institutional money. Once that occurs, you see this background bias, boom. If that locks in, now I don't have a chart with order flow and momentum, but I'm going to show you those. Okay, now I'm going to take this off. Now, I did all that to show you these swing trades. This is our trading chart. And what we're looking for is an entry based on price action and market structure that clearly defines a downtrend. So what we want on a short trade here, this is a C and a potential trade, but we don't trade into pivots. And you can see that this short candle shot a wick through the pivot, but it didn't shoot a candle body. In addition, that's really the key here. We don't trade into support and resistance. Our pivot indicator is real good. And even though this is a fairly small swing pivot, we don't do them. We don't trade into them. So what we're doing is looking for, and here's one trade right here. And if you look, now here's a problem with fractal indicators, and you're gonna have to pardon me, but it's the way Ninja works. When you close and reopen, it pushes everything one candle to the right. And I could go into a lot of reasons why, but that's the way the platform is color-coded. So this red, and red occurred in real time on this trading entry. Just on a look back, it's going to come a candle later. So we had triple reds here. We have the multi-time frame assessment of order flow and momentum, and we're in on this short trade. It evolved over 30 minutes, and it made 8 points. That's a perfect short entry. Now there's another trigger here that I didn't talk about, but if you see this magenta dot on the top of the candle, that means the move back into the trend, which is clearly short. We don't want to take a long trade here, because we're pretty sure that if you trade long, you're going to get beaten up. We want to exploit these long traders and take a trade back into the trend. And we're looking for a trigger to get us in. Now on the entry, we've got 5 reds, and that's a real powerful and nice entry. And this magenta tells us that this candle is a double engulfer, which is really a powerful signal. We just added that a couple of months ago. This candle not only engulfs the previous candle, it engulfs the candle before that. And because it's sometimes hard to see if you're trading more than one instrument, we put that magenta dot there, and you can use it to signal an audible alert that's different from the ABC. So when it occurs intra-candle, when there's a potential for a double engulfer, you're going to get a beep. This shows that the conviction of sellers in this continuation short trade is very strong. Now, this is maximum excursion of the trade. No one's going to get all 8. You're going to scale out of the trade, and you're probably going to take a bounce off the pivot, or you're going to trade into the pivot and close the trade. But all I'm going to do here right now is scale maximum excursion and give you the time. This is going to evolve over half an hour. Now, some of them take 3 or 4 hours. But when you look with no background bias, you don't trade. If you look at areas where there's no red on a short trade, you don't take it. So these shorts, no short, doesn't work. This short, no short, it doesn't work. We don't have enough correlative markets in our direction to guarantee that the trade is going to give us a winner. If you want to take it, you can, but you know it's got a lot more risk if you only have 3 correlative markets, the ones in that third line, red. And because these first and second are neutral, the risk of the trade is substantially greater. And you can see you get a reversal on the entry, and you're going to get stopped out for a full loser. And all I did was wait and look at entries See, this does not give me all my correlative markets. I didn't ignore losers. What I did was I ignored a lot of winners, honestly, because I wanted that winner to be perfect. And there's your on the E-mini, right here. Again, that red, you got to push one candle to the left. And there's no system-generated signal here, but that's a trade off of a rising channel. It's very easy to see. Off of a rising channel, and on the trade in real time, the 50 and 15 are green. Background bias is, I think that's cyan. I might have said it's magenta, but it's cyan. And this candle, the entry candle, runs over traders in your counter trend candle. You always look for that. And you can see that trade went 18.5 points. Now, I can't tell you how much of that you would have gotten based on our ATM, but you would have gotten a big piece of it. And you can't day trade with one contract, but you could swing trade with one. And these are the only entries that we have. I could not find a loser because I'm only looking at the most powerful alignment of up and down. And here's the long trade right here. 3 greens. C candle, and that's 8.75 points, almost 9 points. Maximal excursion. You're not going to get all of it, but you're going to get a big piece of it. And there's your long trade. It evolved over 70 minutes, and that is not a day trade. That's a swing trade. Now here's an overnight hold. When I looked at this, I saw that when you're locked in, you don't close at the end of the session. You continue to hold. So what you trade, maybe if you take a trade late in the afternoon, you got to have enough margin to hold that trade through the night. And if you do, you would have gotten 10.5 points entry to maximum excursion to the downside. I can see what we're doing is we're leveraging all 5 lines. All 9 correlative markets are telling you that the E-mini is losing money. Institutional traders are taking it out. Order flow and momentum on your 2 higher time frames are aligned to the downside. The likelihood of getting a good entry on this B candle, leveraging these counter trend traders going long, is really high. And you can look throughout here. When you don't have 3 reds, now here's a great trade to take a short, we just don't have an entry. There's no entry here. Remember, we're looking for this background to be pink. That's the most likely place we're going to get a winner. Here's another one. This evolved over 3 hours to the downside. It's a consolidation signal. And actually, this one we wouldn't have taken because our third quant line, these 3 sets of markets are not yet aligned to the downside. We want to leverage everything on these trades because you can lose a lot of money on them. The stop would be 10 E-mini ticks. Not a lot of money on one contract, not a huge amount of money on 2. But we want to only get winners. We want to filter out the losers. And that's it. So doing a look back of what we would have gotten was about a trade and a half a week. That's the average number of entries on a swing trading chart. But the precision of the entry, if everything aligns in the appropriate direction, is incredibly high. So that's really, now our signals work on any time frame. So it doesn't make any difference what your trading is. But I really wanted to show you the swing trading entries because swing trading has a really nice, I mean, I'm going to look to try to leverage these entries on our algorithmic system in addition to the normal trading entries we get, because these are great entries. And I'm telling you, I could not find a loser. Our algorithmic system looks to only trade when you got 3 greens, background bias is green, 50 and 15 are green, no upside resistance. It waits for every single independent variable that we know to roll in our direction, and then we take the trade on a retracement to run over a bunch of traders in the counter trend candle. That's when we go. And I'm gonna see if we can't get this programmed. Now I'm going to go back and look at questions, so don't worry about them. I'm sure there are some, and I'm going to go back and get them. Let me just bring up the slides. Now I do want to offer you the software if you're interested. You can call us. We made really good money this week in the live trading room in a very tough market because I just was incredibly patient. I did not trade until everything aligned for us, and they went. And we didn't get big winners, but we made money, nice money. We made almost $1,000 if you traded 4 contracts, and we made almost $500 if you traded 2. That's really good money in a pre-holiday week where we only have 4 trading days. So the goal of our trading is to combine all of the independent variables into a simple trading platform that's been, I left out the T, I always forget to change it, that's been optimized mathematically to provide you with system-generated entries. If you work with us, we'll show you how to take the occasional non-system generated entry like that rising channel into the trend. We only trend trade. Now I took a counter trend trade today. There is one counter trend trade that we do take. It's a very high probability winner, but it takes a lot of setting up before we remember. I understand how difficult it is to counter trend trade. What we're looking for, though, are signs that the institutional players have stepped away and they are gone. And that's how we counter trend trade. When they are in the market, we never counter trend trade, and we have one very clear-cut counter trend trade that works, especially on the E-mini. Now, this is also what we trade off of. This is called our NDT. It's we made it, and it is sitting for a patent. With our execution platform, we don't trade off the DOM. The DOM is too tough. If you pay extra money for the static DOM, you don't have to. What this does is we never take a trade intra-candle. I mean, the market is expressing itself inside each candle. If you don't wait for that candle to close, it's like shutting the market up in the middle of a sentence. You don't know what it's going to tell you. And remember, we look for selling conviction. If we're trading an 8 range, we look for that full 8 range candle body. So we leverage market structure strongly. So we just buy in up close or sell on close down. That's the green here. Whoops. That's this green here, or red here, or pink. And that will execute what almost exactly the close plus a tick and the buy plus a tick. And then we close on a reversal candle, which is if you're taking a long trade, you're going to close on a down close. If you're taking a short trade, you're going to close on an up close. So it helps us get out of our losers with less risk, and it helps us get into our winners with an exact trading entry, with not having to diggle around. If you trade time or if you trade tick charts, you have no idea where the candle is going to close. You can't take a trade until it ends, until it forms and prints, and then you got to run in and take that trade, and oftentimes it's going to go right past you. It's hard to trade with precision off that dome. This NDT takes care of it. It comes with the software, and you can use it to trade anything, as long as you got the dome up on your Ninja Trader. You can use it all day or all night on any trading instrument. All you have to do is take the market and dial in the instrument you want. So here's what we're gonna offer you for the webinar, and then I'm going to answer all the questions. The permanent license on the NDT is normally $1,500. I'm just going to throw that in, and you really do enter trades with less slippage and greater precision. I would never trade without it. I don't have to chase the markets at the close of the candle. It's enough work to determine where the exact price is on the close. To get your buy stop or sell stop in on your trading instrument, on the dome, on the ladder, is very tough. You got to have lightning speed. I'm too slow, and most people are slow. You also get 3 months in the trading room. So I'm the master trader, but you're going to work and you get to trade over my shoulder. It's going to be very advantageous for you. And then you go to trading school. And this is actually one of our trading school sessions. We just combined them. But you're going to have 12 of those. So by the time you're done, the biggest thing that we teach you how to do is trade price action. But once you get a perfect entry based on price action, then we add market structure. So then you're trading price action and market structure. Then finally, after that's done, you use your indicators to help refine your trading precision. You want them to tell you that what you've already assessed based on price action, then you throw in market structure, and then you throw in indicator analysis. So you do those 3 tiers of layering. And when those 3 give you a trading entry, and that's what we look for, it must give us a price action entry that's appropriate, must give us a market structure entry, and we must get indicator confirmation. When we get that, we have a trading entry that's going to work 80% of the time or greater. It just requires patience. And we're going to give you access to our video tutorial library, which is $5.99. And then we're going to give you chart templates for a dozen markets. You can trade anything you like, any time frame, any financial instrument. You can trade minute, you can trade time. We have like 150 templates, and we need to make the templates for you, and because we do them for you, because these are fractal indicators and they all need inputs in their back. Just putting them into your trading chart is not going to work. Now, you can learn how to do them on your own. You don't necessarily absolutely require a template, but it's just a lot easier for us to give you, say, a 21 range crude if you want to trade that, or to give you, say, a 9-minute E-mini if you want to trade that, or a 377 tick if you want to trade that. All the back-end numbers on all the indicators have been put in. Now, the full indicator suite is $27.50. And that's, it's a lot of value because we're giving you the NDT, we're giving you the trading room, and all that stuff. And it's $27.50 or 2 payments of $1,500, 30 days apart. The offer expires on Sunday. And the first 5 orders will also get a tutorial session with me, and I'll work with you as long as we need to get you up and running. Teach you our trading methodology, show you our entries, show you how to read price action, and then show you how to read market structure, and you get to do it with me personally. Now, there's our email address, which I always forget to put in, our website and our email address and our website. And let me get the questions. All right, hang on, because there are a lot of them. Okay. Yes, a lot of people telling me that you can't hear me, and we got that. So let me just go down here. Yes, Angelo, we do the whole format for you. We format it for you. Sergio, who does all our tech, comes onto your website, goes onto your computer, and formats the whole system for you. You don't have to do anything. So, if you have any problems going into the future, we fix it for you. So you don't have to do any tech, because I'm not a techie either. And I go in there, and if it tells me anything except it's great and set up perfectly, I have to call him. So we provide really strong tech support, and you don't have to do a thing. And the other thing about the software is it comes with all future upgrades and add-ons. Like we just added the market profile in exactly the way, and I'll show you our 13. This is our 8-range market profile in real time. And you can see how price is coming up. This is how I do. We trade a 5 range on the E-mini, but I look at the 8 and 13 just because I think it's important if we don't want to trade it sometimes. You can see how price is coming up against market profile. Now that's a big zone. So that zone is a little bit weaker than a tight zone, the one up top. And right now, it's acting as resistance to the upward movement of price. Now we don't have an entry, but you could see how if we try to leverage a trading entry here, it would have bounced right off of upside price movement. Price having a heck of a time getting through the value area low here. And if price is going to have a hard time moving through this zone, very difficult. to move. And we just gave it out. Everyone who has a software got that indicator, because when we do upgrades and add-ons, we just gave it out for nothing. So that's it. We'll send you a link if you want it. You can call me and ask me any questions. Send me an email, ask me any questions to info@Right, and I'll be happy to answer it for you. We do real well in the trading room. I want to, you know, I have to tell you, we made nice money this week in a very, very, very difficult market. Next week, when we got a decent amount of volume back, we'll do better. But you still made almost $1,000 on 4 contracts. You still made almost 500 on 2, and that's the key. So I really appreciate you giving me your time. I hope at least it's gave you pause to think about what you're trading and what you need to get you profitable. You can't be trading fibs, you can't be trading Elliott waves, you can't be using it any indicator that uses data from your trading chart. There's no future look forward period. You got to look at the 2 higher time frames and wait for them to align. You got to look at correlative markets to show you the direction of institutional money. That's what increased the precision of your trading entries remarkably. When all that aligns, you're very likely to get a winner, even in a really lousy low volume market environment like this week. So listen, have a wonderful holiday, a happy Easter, and no matter what you do, I really wish you the best of luck and best of health. And you know, we're just a small commercial trader. We're up against the institutional guys, and we're up against the other commercial traders. Those are the people that we need to beat up to make our money. And we need to catch them in those counter trend channels. We need to catch them counter trend trading the market when institutional money is flowing in the opposite direction. And when we do, we're going to run them over almost every time. So listen, have a great weekend, a great holiday, and best of luck. Thank you. Thank you. Same to you, Angelo. Take care, everyone. Bye-bye.